Welcome to this explainer. I am absolutely thrilled to have you here today because we're looking at what might literally be the most fascinating setup in modern macroeconomics. Today we're unpacking the massive domino effect of the Federal Reserve delaying its interest rate cuts. I mean, we hear about the Fed constantly, right? But the real story is how their decisions ripple outward, completely shifting the ground beneath both traditional assets and modern digital assets.
So let's kick things off with a critical question. The Fed is delaying rate cuts. So, are your investments ready? Understanding how global market updates impact your portfolio isn't just theory anymore. It is the absolute key to staying ahead. When the cost of borrowing money stays higher for longer than anyone anticipated, it forces every single investor, from the retail trader all the way up to the largest institutions, to rethink their entire strategy.
All right, here's our roadmap for today. 1. Why delay rate cuts? 2. The impact on gold. 3. The impact on Bitcoin. 4. Gold versus Bitcoin. And finally, 5. Future market scenarios.
Section 1. Why delay rate cuts? Zero. Yep, a big fat zero. That's exactly how many rate cuts have materialized so far, which is in stark contrast to what the markets expected at the start of the year. The gap between Wall Street's expectation of cheap money and the Fed's actual reality is causing massive friction. Wall Street had completely priced in relief and, well, that relief simply didn't show up.
So why on earth did the Fed slam on the brakes? Well, it really just boils down to stubborn inflation combining with surprisingly strong underlying economic data. When the economy stays this hot, the Fed is essentially forced to keep rates high to cool things down and prevent prices from spiraling out of control. Think of it like trying to slow down a speeding freight train. You can't just lightly tap the brakes. This unexpected economic resilience completely forced the Fed's hand, setting off shockwaves across all asset classes as everyone rushed to reprice this new reality.
Moving right along, Section 2. Impact on gold. Now, as you probably know, gold serves as that traditional safe haven vault. When inflation runs hot and rate cuts are paused, uncertainty spikes. And historically, what do investors do when they're uncertain? They retreat to physical security. Much like the massive inflation spikes of the 1970s that sent prices soaring, gold doesn't pay a yield, but it carries thousands of years of psychological weight as a preserver of purchasing power when fiat currencies are battling inflation.
But investor reactions show this incredible tug-of-war happening right now. A hotter-than-expected inflation print might drive gold up as a hedge, sure, but if that means the Fed is going to keep rates high, a stronger US dollar can simultaneously push gold right back down. It's a constant, high-stakes rebalancing act as the market digests every single new inflation metric.
All right, on to Section 3, impact on Bitcoin.
Now, unlike gold's dusty physical vaults, Bitcoin's reaction is driven by a distinctly modern ecosystem. We're talking about heavy ETF inflows and the incredibly rapid moves of institutional investors. When institutions see delayed rate cuts, they instantly adjust their risk models. And because Bitcoin trades 24/7 globally, the influx or exodus of institutional money happens at lightning speed compared to traditional commodities.
You know, this digital ledger environment creates some pretty intense market volatility whenever the Fed changes its timeline. Bitcoin is highly sensitive to liquidity. So if the Fed delays rate cuts, it means liquidity remains tight. For a high-growth, high-risk asset class like crypto, that translates into massive price swings, sometimes shedding or gaining thousands of dollars in a matter of hours purely based on Fed commentary. The delayed cuts act as a sudden headwind against the momentum of Bitcoin's institutional adoption. Which brings us to Section 4, gold versus Bitcoin.
Let's directly weigh these two titans against each other, head to head. On one side, we have the physical stability of gold, deeply rooted in history. On the other, the digital dynamism of Bitcoin, fueled by technology and new financial vehicles. Both are often pitched as alternatives to the traditional dollar system, and yet they react to the Federal Reserve's rate delays in completely different ways.
Their risk-to-opportunity profiles diverge sharply in a high-inflation environment. Gold gives you steady, safe haven performance, a lower-risk, traditional hedge that preserves wealth. Bitcoin, conversely, gives you high volatility, carrying much higher risk but offering significant institutional upside. Honestly, your choice depends entirely on your personal appetite for volatility while we all sit here and wait on the Fed to make its next move.
Finally, Section 5, future market scenarios.
Let's logically forecast how these markets are going to react going forward. Scenario 1. If inflation stays consistently high,
Expect gold to lean hard into its historical role as a preserver of wealth, while Bitcoin might really struggle against that tightening liquidity. Scenario 2, if the Fed continues to delay rate cuts, we're looking at prolonged market chop, just sideways volatile action as uncertainty rules the day. And Scenario 3, if interest rate cuts finally begin, the floodgates of liquidity open, potentially igniting a massive risk-on rally that could send Bitcoin surging while completely shifting the underlying mechanics for gold.
I want you to really remember this central thesis. The Fed's next move could shape the future of gold, Bitcoin, stocks, and the global economy. You simply cannot look at gold or Bitcoin in a vacuum. The Federal Reserve is the engine driving the entire global economy, and the levers they pull with interest rates dictate the flow of capital around the whole world.
So, I'll leave you with this final thought to ponder for your own portfolio strategy as we wait for the latest updates on inflation and market shifts. Are you subscribed and ready to stay ahead of the global economy's next move? Are you paying close enough attention to the data to actually anticipate what happens next? Because in a landscape where the cost of money is constantly shifting the balance between physical vaults and digital ledgers, staying informed is without a doubt your greatest asset. Keep analyzing, keep learning, and I'll see you in the next explainer.